Bleeding Edge subscribers, happy Friday, and hopefully you guys are having a great day. So look, if you've been following us all week, I'm calling the month of April and then really the next 4 weeks the most important stretch we'll see in the stock market all year. And if you haven't read my two previous newsletters or watched the videos, links are down below. Look, these next 4 weeks will define where the markets are heading for the remainder of the year. That's because we're heading into an important earnings season, which officially kicks off next week. Public companies, as most of you know, report their earnings every quarter, and it's kind of a report card, if you will, of how a company is performing. Probably more important for investors, we're inundated with financials and data, which we really can drive stocks and really the stock market up or down. Next week on Friday, early in the morning, before the market opens, we'll receive some of the most important data we'll get all earnings season. The data is so important, it can indicate where markets are heading over the next several months. In fact, the last time markets saw data points at these levels was right before the 2022 stock market crash that wiped out many investors. In many ways, you can say this data point can predict a stock market crash. And today I'm going to discuss what you can look for. One of the largest financial institutions in the world reports their earnings next Friday on April 12th. And inside that financial report is data that could signal which way the markets are heading for the rest of the year, potentially even beyond that. JP Morgan is a bank so dominant and with so many assets under its management that even if you have zero interest, no interest in ever owning shares of the company, you must pay attention when the company reports their quarterly earnings. For years, I've been covering the company on YouTube, and I've always emphasized that the company gives us a window into the consumer and other businesses. That's because with nearly $4 trillion under management at the company, it's the largest bank of its kind. And while there are many aspects of JP Morgan's financial report that are worth paying attention to, including CEO Jamie Dimon's 2 or 3 paragraphs right at the beginning that are filled with one-liners and headline-grabbing quotes, the most important line is one many investors tend to overlook. And while I'll be paying close attention to this metric a week from now, because as I indicated earlier, the last time we've seen it at these levels was right before the 2022 stock market crash. What I'm talking about are loan loss reserves. And it's not something you see many financial experts discuss regularly. But loan loss reserves is money that JP Morgan essentially sets aside to cover loans that are either delinquent, in default, or needed to be renegotiated. JP Morgan set loan loss reserve levels considering kind of past loan performance, current economic conditions, and also expected future economic conditions or future losses. The loan loss reserves are recognized as an expense on the company's financials, which means they can directly impact the company's profitability and its stock price. But what loan loss reserves is it paints a picture of the overall health of consumers and businesses. Higher loan losses means companies, consumers might be struggling to pay off their debts. Using economic data from the St. Louis Fed, we can see that loan loss reserves at all major banks rapidly rose in 2020 due to the economic uncertainty the pandemic ushered in. However, thanks to government stimulus and low interest rates, banks didn't realize much stress during this time period, but that's not the case right now. We're seeing over the past year, loan loss reserves are steadily rising again. In fact, we're at levels not seen since 2022, right before the stock market took a major nosedive. If we combine the fact that banks are setting aside more money for loan losses with delinquency and charge-off data, things are really not looking good. Consumers are delinquent on their credit cards at a rate not seen in over a decade. Commercial real estate loans are in a similar predicament. Unlike the federal government, businesses and consumers like you and I, we can't just print dollars to pay our bills. The data shows the impact of a sustained inflation and higher interest rates are taking its toll on the economy. And in large part, the financial markets, which are near all-time highs, really hasn't priced a lot of this news in. Next Friday could be the first indication that markets begin to pay attention to this all-important data. We'll certainly be here to cover it for you here on The Bleeding Edge. I hope you have a fun and safe weekend. We'll see you again next week.